Hello everyone, welcome to week 7 learning videos once again. We have seen that passive screens are one of the approaches that can be used to try to exploit a philosophy that is based on value investing in our last video. In this learning objective, we look at different passive screens that can be used by investors and analyze the evidence regarding the efficacy of such screens. So as we spoken earlier, the key founding father of value investing is Ben Graham. And Ben Graham back in the 20th century had a range of screens that he applied in order to identify stocks that have a low price relative to their fundamental value. While we actually see on the screen here 10 passive screens that Ben Graham adopted, his view was that we should buy stocks that meet all these screens. As you go through the screens, you can actually identify that all 10 screens in some ways measure of the price relative to different aspects of the fundamental value of a firm. For example, number 1 is the price earning ratio of the stock that has to be less than the inverse of the yield on corporate bonds. So it basically wants low price earning ratio, remembering the price earning ratio is the price of share to earning per share. It's a measure of how many times multiple earnings do you have to pay to buy the stocks. Second one is the price earning of a stock has to be less than 40% of the average price earning over the last 5 years. Then the dividend yield has to be 2/3 of the AAA rated corporate bond yield. And you can see that the market price has to be lower than book value, 2/3 of book value, and market price has to be lower than 2/3 of net current asset. Debt equity ratio has to be lower than 1. It means that debt has to be less than equity. Current asset has to be higher than twice of the current liabilities. That means the firm must have a very good liquidity position. Debt has to be less than the net current asset, so firms must have liquid asset to be able to pay out debt. Historical growth in APS has to be higher than 7% and no more than 2 years of negative earnings over the previous 10 years. So when all these rules come together, he is actually looking at firms with solid business fundamentals that have a low price relative to some measure of their fundamental value. Now the question is, how well did Graham's screens perform? Well, one way that we can really clearly find evidence of the success of Graham's approach is the fact that we are still talking about him today. Ben Graham is viewed as a very highly successful investor, and his approach to investing has been adopted by literally thousands or millions of investors through history. Now, if we look at some of the academic evidences regarding the performance of value investment strategy, Oppenheimer in 1984 reported that stocks that passed all of Graham's screens were actually able to earn a significantly higher return than the market. However, while there was evidence back in the 1980s that Graham's screens perform well, we have found subsequently that there is very limited evidence about the success of Graham's strategy. But that is not due to the lack of the ability of value investing to continue to be working. It more reflects the changing market mechanics where you actually find very few, if any, firms that nowadays meet all the 10 screens. This is largely due to decreasing dividends and much more use of the leverage by firms nowadays. So very few firms actually satisfy all these requirements, and that means that while the general idea behind what Graham suggested all those years ago is still relevant today. However, maybe a mixture of a different range of passive screens might be required, and maybe a slightly more parsimonious approach whereby there is not quite so many hurdles that firms have to jump over in order to be successfully included within a portfolio. And I said before, Graham's best claim to fame is the success of many of his students who took his class on value investing and learned from his approach. And the most famous value investor of all is Warren Buffett. So Warren Buffett is a value investor, though according to his books, uses a range of value screens quite substantially different to those that were applied by Ben Graham. So it's the same underlying philosophy, but quite different way of executing the value investment strategy. Buffett believes in four tenets, four different features that you look at to identify a good value stock. First one is business tenet. Business tenet is that the business should be in a simple, easy to understand industry and should have a strong history of operating profitability. Second one is management tenet. Management tenet is Buffett believes that managers have to be good leaders and also well qualified to be able to lead the firm. The financial tenet says that the firm should have a higher return on equity and hence should have very good profitability across time, with owner earnings being quite high and quite stable across time. Market tenet often talks about the idea of boost to market, and this is the view that there are outside forces that can affect the valuation of businesses and evaluation of stocks. So Buffett tends to use very conservative estimates when valuing companies, and the use of conservative estimates is that only those firms that are extremely cheap relative to his estimation of fundamental value will actually fall into his portfolio. So if we can compare Ben Graham versus Warren Buffett, as I said, the same basic principle, same idea of trying to identify stocks with low market price relative to the fundamental value, we can see that the screens they use are very different. Ben Graham's are systematic screens. They are clear and objective, and there is no subjectivity involved in a decision rule. And you could perform a computer to trade with an algorithm based on the rules that are set up by Graham. However, Buffett's screens are highly subjective and there is a lot of discretion involved. So this could be argued to be the main reason why many investors have tried, but very few have succeeded in replicating Buffett's approach. It requires his own secret herbs and spices, his own ability to look managers and assess their ability as leaders, and his people, and his own ability to look at the business and inspect it and examine the prospects of that particular business. So the problem of Buffett's approach is that unless other investors are able to have his particular skill and his particular access, this is probably an approach that can be replicated by average investors. Probably what a value investor will be looking for is a more systematic approach, a more rules-based approach that does not involve the subjectivity that's incorporated into Buffett's approach, because most investors won't have his skills set or more particularly his access to managers and to businesses. So let's look at some alternative value screens that you might think about if you are trying to look at an appropriate, a systematic, objective value investment strategy that is relevant in the 21st century, hence does not have the degree of complexity that maybe Ben Graham's screens had. So the four most common screens that tend to be used by value investors are the book to market ratio, price to earning ratio, price to cash flow ratio, and dividend yields. All these ratios are effectively a measure of a stock price as a ratio of the fundamental value of a firm. In the case of a book to market ratio, book value of the firm or the accounting value is being used as the firm's fundamental value. So if you have got a high book to market ratio, it means that accounting value of the firm is high and the market price of the firm is relatively low. So a firm with a high book to market ratio would be seen as a cheap stock that one should buy. Price earning ratio, as we mentioned before, price earning ratio is the ratio of share price to earning per share, or it's a multiple of current earnings that you have to pay to buy that stock. Hence, a low price earning multiple would imply cheap stock or a value stock. Similarly, price to cash flow ratio is the price is the numerator and the cash flow is the denominator. So it actually indicates the multiple of price you pay for every $1 of cash flow generated by a company. So a low price earning ratio indicates that you are actually paying lower price for this share for the cash flow generated by a company. So you are actually buying a relatively cheaper stock. And the last one is dividend yield. Dividend yield is calculated as the latest dividend divided by current market price. So it's basically indicate that how much you are paying for every $1 of dividend. So high dividend yield indicates that the stock is paying higher dividend relative to its price. So we would buy a stock with high dividend yield because it indicates a firm's ability to pay high dividend relative to its price. So it's a cheaper stock. So a couple of rules that need to be applied if we're going to consider value screening. The first one is value does not outperform growth in every single time period. Evidence suggests that on an average, value outperforms growth. So if you have a long-term horizon, this should be a successful investment strategy. It should not be used for investors that are only seek to invest for a short period of time. Second point is it's also important that investors choose their screens wisely. Too many screens might result in Ben Graham's problem, whereby you actually eliminate all stocks and you won't find firms that actually are able to meet the requirements of their screens, whereby too few screens might be too simple. So yeah, maybe it's a combination of a couple of screens that might be used, but again, there is where backtesting can also be an important way to identify an appropriate approach with a view to also minimizing the turnover. Pharma French in their study in 1970 actually compare all these different value screens that we have just discussed in the last slide, and they argued that the book to market ratio is the most effective predictor of future returns. So their view is that it is the approach that should be used as a passive screens by investors. So here is an example that how a value investment actually performed in the United States for a period of 1952 to 2011. So what I have done here is during this period, on an annual basis, I have ranked all the stocks on the basis of these four value screens: book to market, P ratio, price to cash flow ratio, and dividend yield. So what I have basically done is, let's say we are in 2018, so I have ranked all the stocks on the basis of these four value screens they had in 2017. Then I divided into these 10 decile and hold the portfolio for next 1 year, and then continue to rebalance this portfolio on a yearly basis. So these are the average returns generated. Average return means annual average return generated by each decile portfolios. Those were created on the basis of these four screens. And the smallest decile basically indicate the growth stocks, and the last decile, I mean decile 10, includes value stocks. So it means that this number 10 decile, this decile basically includes the stock that have the value stock. That means the stocks those have the cheaper price relative to their fundamental, and this decile 1 includes a stock that have these value screens relatively higher. I mean you pay higher prices relative to fundamental. And we can see that this annual average return increases monotonically from this decile 1 to decile 10, and we can see that the value portfolio generates significantly higher return compared to growth. And this is particularly evident for a book to market, price earning ratio, and also for price to cash flow ratio. However, the evidence for dividend yield is not that clear. So this evidence basically is consistent with what Farmer and French said, as we discussed in the last slide, that the book to market ratio is the most effective predictor of stock returns, and a value portfolio generated based on book to market ratio significantly outperform the growth portfolio. And this is the return generated by the value portfolio of a zero investment portfolio, basically. So what we have done here is we have taken a long position on the value portfolio and the short position on the growth portfolio. And these are the main difference between the value portfolio returns and the growth portfolio returns based on those value screens. Okay, so we can see that all these returns are positive. It means that the value portfolio generates return higher than growth portfolio. However, for these three portfolios, we can see that return differentials are significant. It means that in the case of book to market, price to earning, and price to cash flow ratios, the value portfolio substantially outperform the growth portfolio. However, the value portfolio constructed based on dividend yield doesn't provide evidence to outperform the growth portfolio. So once again, this evidence is consistent with the Farmer French finding that the book to market ratio is one of the best predictor of stock returns, and that actually generates a value portfolio that outperforms growth portfolio. The example that I just discussed in the last two slides are US evidence. Now, this is Australian evidence. So what I have done here is I have taken this example from this paper, Doherty, Chan, and Eston. So they have created a quintile portfolio from a period of 1975 to 2006 based on book to market. So here the quintile one is actually the portfolio that has the lowest book to market ratio, and these quintile 5 that has the highest book to market ratio. So highest book to market ratio indicates a value portfolio, and you can see this value portfolio substantially outperforms the growth portfolio in terms of return generation, because you can see that this value portfolio generates a return about 1.7%, whereas this growth portfolio generates only a return of about 1% on a monthly basis. So we can see that in the United States as well as in Australia, there is a substantial evidence that value portfolio outperforms growth portfolio. So value investing appears to outperform across the world, and there appears to be a different screens that can successfully pick up value stock and can be used to generate abnormal returns. So given the success of this investment strategy, it has actually been adopted by quite a large number of managed funds around the world. One example of such fund is the Dimensional Fund Advisors. Dimensional Fund Advisors, interestingly, have Chin Farmer and Ken French as consultants that we spoke before. They're basically the key academic drivers behind the idea of value anomaly. The Dimensional Fund Advisor has an Australian value trust, and just out of interest, we look at some of the names that are held within this value trust, and you can see these names: National Australia Bank, Australia New Zealand Bank, Macquarie Group, West Farmers. So they basically tend to be the large Australian companies, and they were considered as value companies at certain point in time. Just to finish up this learning objective, what are the determinants of success with being a passive screen? First of all is long horizon. As I discussed previously, that the value screen outperforms passive screens. I mean, value portfolio outperforms the growth portfolio. It doesn't necessarily mean that value portfolio will outperform growth portfolio in every point in time. However, on an average, if we hold these portfolios over a long period of time, value portfolio is supposed to outperform the growth portfolio. The second one is we have to choose our screens wisely, because as I mentioned previously, that if we choose too many screens, probably we'll end up eliminating all the stocks, whereas if we choose too small number of screens, probably we will end up stocks those are actually not good value stocks. And your portfolio has to be diversified. So just like value does not outperform growth in every single month, not every value stock outperforms every growth stock. It's simply just the average portfolio of value stocks outperform the average portfolio of growth stocks. So my point here is that you need to be diversified. It is not simply just a matter of investing in one value stock and outperform all the growth stocks. And last of all, like with any other investment strategy that moves away from passive investing, you have to be careful about taxes and transaction costs. So being aware that some screens may end up creating portfolio of low price stocks, but those low price stocks might be small, neglected stocks that have high transaction costs. And also being aware of frequently turning over your portfolio that may increase your tax exposure. So that's the end of our discussion on learning objective 2. Please watch the next video for our discussion on learning objective 3. Thanks.